Very happy to have here as our final speaker for the day, Ted Lanzaro, CPA. He is an expert on real estate taxation. And we've already had some questions about this come up, and we've deferred them until now, the same way that you can defer your taxes. So I'm going to turn it over to Ted to introduce himself and tell a little bit about his background, and then we're just going to jump into basic tax advantages of real estate, how you can take advantage of them as a syndicator, some of the special things that are available to syndicators, maybe some things that you think are available to you that are not available to you. So we'll walk through all of that stuff. So Ted, take it away.
Okay. My name is Ted Lanzaro. I run a tax consulting firm for real estate investors out of Cheshire, Connecticut, which is about 2 hours from here, a little south of the Hartford area. And my firm is nationwide. We do business with investors all over the country. Been doing syndicated partnership work for close to 30 years, and just really started getting involved with multifamily syndications probably in the last 2 or 3 years, because most of the work that I've been doing in that space was more shopping centers, office buildings, and so forth. So right now, what I do, and so if you wanted to play a drinking game, you could take a shot every time I say the word proactive. You're going to hear that a lot, and because that's what my practice is all about. It's about the proactive approach to your taxes, because most tax savings doesn't happen in February when I prepare returns. Most of it happens during the year when you're buying, renovating, selling real estate, and when we do tax planning for clients in October, November, and December. So let's, we'll kind of keep that in mind. Those are some of the things that we will talk about. I'll tell you 2 other things that we'll kind of start with, which is everybody here in the room is different. So there is no real, even though we're going to talk in a general fashion, everything that we do and all the strategies we use and the strategies that are outlined in my book, The Tax Smart Landlord, all have to be specifically applied to your situation, and that situation is going to be dependent on a whole variety of factors.
So there was a question that came up earlier, which I didn't quite capture, but it was about, as a syndicator, whether you can take depreciation. Now, this is like a big issue, I think, for a lot of people, because depreciation is the big one that everybody wants, other than maybe 1021, it's the offsetting income and stuff. But as a syndicator, there's a bit of confusion, and maybe there's confusion in the law, about whether the syndicator can take depreciation back. So can you talk about that issue a bit?
Yeah. So keeping in mind, first, that tax laws aren't always black and white, okay? There's gray there, and in a lot of cases, things are subject to interpretation, and there's accountants out there who don't even believe in cost segregation, for example. So, like, oh, cost segregation, no, you don't want to do that, right? And so, or don't take the home office, or a whole bunch of things that are pretty black and white stuff that there's tax accountants out there who are telling their clients not to do this stuff. It's too aggressive, okay? So the question really comes down to this. There's 3 different types of investors. We're going to talk very generally speaking, and we can get a little more detail. There's 3 different kinds of types of investors. Passive investors is the first one. A passive investor is somebody who is like a person in your syndication. They're just turning over some money with the expectation of a return, but they're not going to do anything. They're not part of the active management or role in any way in the partnership. They're just going to put their money in with the expectation of getting a return back, okay? They're a passive investor. Generally speaking, a passive investor is not allowed to deduct rental losses against their ordinary income. That's the rule. The second category of investors is active investors. And Frank would be an active investor. He's a guy who owns a portfolio of properties in and around Rhode Island. He actively manages them. And so he would be considered an active investor. Until and unless he got to a point where his income exceeded $150,000 a year. We'll get to your exception in a second. But until you get to a point where your income exceeds $150,000 a year. At that point, if you are, so I have a lot of these kind of clients, people who are high-income W-2 employees who have small local rental portfolios that they manage. They own a bunch of 2, 3, 4, 10 family properties in and around their locality, and they're actively managing them, but because they're high income, they're not able to deduct their rental losses against their ordinary income. They are in essence active passive, but they're treated as passive in terms of the tax code. So again, all passive means is I can't deduct my passive losses against my ordinary income. The third category, which you would qualify for probably, is real estate professional, okay? And a real estate professional is somebody who is active in a real estate trader business. They put over 750 hours a year into that trader business, and it's more than 50% of what they do, okay? And if you qualify for this, right, then you're allowed to take your rental losses against your ordinary income. So what ends up happening is everybody wants to qualify to be a real estate professional, right? And that's where some of the issues come in. I'm getting more and more calls from high income, high W-2 income earners, okay, who are both limited partners in deals and general partners in deals. And their question is, can I deduct the losses from my passive investments against my ordinary income? And the question is, and the answer is maybe, if you can qualify as a real estate professional. So I've spent a lot of time on the phone with people lately, basically going over the rules, and not only the rules, but the proactive approach, that you would take to document that, right? Because the key is the documentation, because when you do get called into the auditor's office, that's the first thing they're going to ask for, okay? Now, so a lot of you have probably heard me tell this story, but I had a client who wanted to be classified as a real estate professional. I knew she had a 40-hour-a-week job, and she's like, no, well, I know I work 40 hours a week, but I also work 50 hours a week in real estate. I don't even sleep, blah, 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 right? And I told her, I don't think you don't qualify. And she says, I do. And I said, no, I don't. I'm not going to prepare your tax. And she said, okay, you're fired. And she left. Yeah. And, a couple of years later, I'm sitting at my desk, ring, ring, phone rings, and it's her. And she's like, you remember that year that you said I wasn't a real estate professional, and I filed my own return, and I said I was a real estate professional? There's a lady down in the IRS office in New Haven who would like me to come in for a meeting to discuss this. Can you help me? And I said, no, honestly, I can't help you. You don't need a CPA anymore. You need an attorney. Or a magician, Somebody who's going to make this go away. Or you just need to walk in there and write a check, which is what she ended up doing. The point being, and just to give you an idea of, and so the other side of that, right, is that there are good auditors and bad auditors, right? So I'm doing a presentation one day, and I'm teaching people how to do the documentation for this, and I had a guy stand up and say, my friend, he had all of the documentation, and he took it all into the IRS, and they still disallowed his deduction, right? I'm like, wow, that's unusual. I hadn't heard of that one before. Okay. And then I'm talking to a guy the other day, I'm talking yesterday. In fact, I'm talking to a guy on the phone, and we're talking about this exact topic. And he says, yeah, he says, I went to the auditor, and the auditor said, well, go home and make a log and bring it back, right? I'm like, wow, you got lucky, right? You know, so it's a kind of the difference between those two approaches. One guy, you know, generally speaking, I don't like to rely on luck. I like to rely on documentation, right? So that's what that's one of the things I teach.
So, since we're on the topic, how would you document this? What's the best way to go about documenting your status?
Yeah, I mean, what I like to tell people to do, and it can be easy. What I want you to do first of all is pick a format that you're going to use, because I can tell you do it in Excel or use your CRM or QuickBooks does time tracking now, right? Whatever it is, I want you to use the thing that you're most comfortable with, right? Because I would rather have a good legal pad where you hand wrote in stuff than a crappy Excel spreadsheet that I can't even read, right? Or something in QuickBooks that's illegible, or an app that you use sometimes, right? So first of all, pick a methodology that you're going to use, right? And then the next thing would be you have to literally say, okay, today for an hour, and let's say you're a real estate broker, right? That's your claim to, or a landlord. Let's use a landlord, for example. So I'm a landlord. I'm a real estate professional. What did I do today? 1 hour. Went to 123 Main Street to collect rents, right? Okay? I just documented that. Next day, 1.5 hours. Showed vacant apartment to Mr. Smith. Maybe I took an application, and so I wrote application on the road. The more detail that you can provide on your time tracking, the better off you're going to be. Okay? It sounds like a lot of work. It is, right? But it's the flip side of being able to take a $200,000 tax deduction potentially against your ordinary income, right? Which might be a $60,000 or $70,000 tax reduction in the year you take the bonus depreciation. So you kind of got to do the legwork in order, especially if you're trying to combine it with a W-2, right? Because I don't think there's a bigger red flag to the IRS than a real estate professional with a W-2 job, especially one that is making $200,000 or $300,000, or more at, right? So I'm talking to a guy who works for Apple, right? I want to be considered a real estate professional. Dude, you're going to have a hard time doing that. I want to manage expectations up front,
So are there activities that qualify and activities that don't qualify? Let's say, for instance, you are a syndicator, right, and you're running a business in real estate. Would your marketing activities and your activities in running the business qualify, or only things that are actually touching real estate?
Well, if you look at the actual definition, it says it's an active real estate trader business, right? And in that scenario, what you're really doing is you're raising capital as a syndicate, right? So I like that one. Financing, real estate financing, is one of the approved activities, right? What I see too much of, right, and I'm counseling people, is people who aren't making. So what the other thing I would say to you is, if you're doing that, I think you should be making money at it, right? So running it as a trader business with the idea that I am actually purchasing properties, I am acquiring and taking acquisition fees. I'm literally running a business, right? So I'm paying expenses, I'm doing marketing. So all of this stuff, I'm in the real estate business, right? It's my job to acquire properties, to raise capital for properties. So I think that
So all that stuff that goes into running the real estate business would qualify. It doesn't have to be specifically like managing the property or asset managing the property, things like that are very clear.
asset managing is a better example, right? I mean, so I think there's differing degrees of certainty, right? So if I'm a real estate broker, that's a no-brainer, right? If I'm a property manager or a landlord, and that's all I do, no-brainer. If I'm a startup syndicator who hasn't done a deal yet, and I'm just starting to put together the kind of structure to syndicate a deal, so I'm just starting to meet, just starting to build relationships and whatever, and I haven't done a real estate deal yet, and I try to, or my only deal is I gave somebody $100,000 to put into a syndication deal, I probably have a problem, right? That's going to be more of an issue. Not to say that you couldn't do it, but that's one that I think would get flipped, right?
What about the guy who has built a portfolio? He's done such a good job of organizing his business that he's got basically everybody else doing everything for him. He's not really working that much because he doesn't have to. He's just like making sure everybody else is doing their job. So he's not actually spending that many hours doing it, and 100% of his income comes from real estate. Like he owns a real estate company.
Did you put in 750 hours?
So you still have to meet that third hour. So even if 100% of your income's coming from that, and you own the business, and you're really good at running the business, so you don't have to work that much, you wouldn't qualify in that situation.
No, like if I was 4-hour work week in it, something like that, probably not. Because I didn't work the 750 hours.
So pad your time sheet.
Well, pad your time sheet,
What's that? 750? That seems like a lot of work to me.
30 hours a week.
30 hours a week. Okay. So, and let's go back to that question that was asked before. I think a lot of this was sort of a setup.
Yeah, I'm thinking half the day. 2 hours a day.
People work 2 hours a day. But so the question that was asked before, one of the topics was, so now you've set the stage for whether you can legally benefit from the depreciation of the properties or not. This added wrinkle, you're a syndicator, right? Can you take the depreciation in that situation?
Let me get my Facebook Live on my home site.
Who was it that actually
We
asked that
got
question?
enough cameras
Was
here.
it, Alex, was it you that asked that question?
I had heard that the GP.
Yeah, so can you re-ask the question to make sure I get it
I
right?
heard that the GP cannot take the value of a cost seg study.
cost seg,
Only the LPs can.
The opposite based on
Depreciation.
Here's the answer to that question, right? I mean, so it goes back to what we were talking about. Passive, active, real estate professional. In this scenario, it's only passive or real estate professional, right? Because the general partner is either going to be a real estate professional or they're going to be, because there's a lot of syndicators that I know who have jobs and are syndicating properties,
So
right?
let's just say that you
Okay.
are a real estate professional GP.
Okay, right? So now you qualify as a real estate professional, right? Do you have basis?
That's
Did you put anything in?
No, that's the.
Then so there's 3 sets of criteria, right? So the first criteria is what kind of investor are you, right? Do you even qualify to take it? Because the other 2 criteria, which are, is my investment at risk and do I have any basis, right, are irrelevant unless you're a real estate professional, right? So if you let's say you qualify as a real estate professional. Now, so in a lot of cases, I may be the syndicator, the operator. Maybe I'm getting a carried interest, right? If I've raised capital, and I'm going to get the 15% of the deal for raising that capital, or what you were talking about before, being a KP and getting 20%, 30%, 15%. Dan said, well, I didn't put any money in, so I have a carried interest, which is awesome, right? I mean, if I get capital gain treatment on that if I hold it for 3 years, right? So that's fantastic. I did a service that I probably should have been paying ordinary income tax and probably Social Security and Medicare on, and I'm going to get capital gain treatment somewhere down the road, right? But I don't have any basis in the property, right? Now, so that would disqualify me from taking the bonus depreciation. I don't lose it. It just carries over, right? And I think it's a misnomer for people to say, we're gonna allocate, who are we allocating the depreciation to, right? Because there's no line item on K1 that says, here's your depreciation, right? It's rental loss, okay? And that rental loss could be a combination of a whole bunch of things, right? It doesn't have to be all bonus depreciation. In most cases, it's mostly bonus depreciation, but it could be a lot of repairs, could be a lot of mortgages. For not every property cash flows in year 1 and 2, right? You know, so it could be, so everybody gets allocated their portion of the real estate losses. And then their ability to be able to take those losses is subject to whether or not they have basis, right? So even if they are a real estate professional, they still have to have basis. And if you didn't put any money in the deal, you don't have any equity basis, right? So the only other way to get basis would be to have loan basis, right? And loan basis is going to be, I'm obligated on the loan, right? But there's different kinds of loans, and so your loan basis, if it's completely non-recourse, then you don't have any dollars at risk in theory, right? Now, we were talking about this before. You have somebody who wrote a paper on, a white paper on a rationale for allocating, for creating loan basis. You know, I'm gonna argue that, you know, even if it's a non-recourse loan, I have loan basis, right?
Yeah, well, just to clarify though, so when you talk about the basis, the argument here is, I guess it's a term of art, the economic risk of loss, right? Are those two separate things, or can I create basis based on my economic risk of loss?
Loan basis
Loan
you
basis.
create from your economic risk of, well, you have economic risk of loss on your equity basis too, right? So that's yeah.
The argument that this CPA specifically was saying was, if you're, let's go back to Alex's point, if you're a professional real estate investor, you're Alex, that's all I do. I syndicate, and I do an 80-20 deal, right? 80% of the profits go to the investors, I keep 20% as a carried interest. I put no money into the deal, and it's a non-recourse loan. Can I take 20% of the losses because I own 20% of the shares, even though I put no money into it, this is all carried interest, and it's a non-recourse loan? The argument then, I thought the argument against it was, well, you have no economic risk of loss because it's not a thing. This person was asking, there's an argument to be made that you do have economic risk of loss because of A, B, C, D, E, which I don't remember what they were, but there was an argument to be made that I guess there's carve-outs in carve-out, right? The bad boy carve-outs, does that count for something? Is there other ways to generate economic risk of loss so that my 20%, that it's purely sweat equity, I get to take 20% of the losses?
And what about at-risk earnest money? I mean, you're getting that back at closing, but that is at-risk capital. So I mean, it's kind of two layers of this conundrum.
Right, and so the general answer is, if I don't have any dollars in the deal, and I don't have any economic risk of loss from the loan, then no, I can't deduct the passive loss against my ordinary income, right? Now, so then the question becomes, can it be written into, so here's where here's where you and I make our money, right? You know, it's okay, well, that's the rule. So now how do we come up with a way around that so that Alex can take his, take his dollars, okay? And that's going to be in some part how the agreement is written, right? Because if the agreement is written in such a way that it creates economic loss,
I think that's what we did.
right? Then you have at-risk dollars, right? Whether it be earnest money or future liability on debt or whatever it is. You have that. You still have that limited. You still have that.
You kind of manufacture the economic risk.
You manufacture it,
So
right?
you can have your cake and eat it too and have non-recourse debt, but you can have an operating agreement that says somehow that is at risk.
If it's structured properly, right, yeah, if that's the way, and I'd be interested in seeing what the arguments were, but that would be the thought process, right, would be, look, I'm going to structure the agreement in such a way that I'm creating some economic risk for myself so I can deduct depreciation.
Well, I mean, it's logical, you do have that risk, I mean, it's not recourse, but with the carve out, you have, and even without, I would argue, I mean, I'm an attorney, but I would argue that if the deal goes south, the guarantor, that's their function, that's their liquidity. So they are trading one risk for the upside. So how do you not have economic risk?
Right, and that's exact. So that was very nicely stated. That would be what we told the auditor, right? You know, when we go into the office,
You'll
right?
sign on
and then you're hoping. But here's the thing, right? So think about it from this standpoint. Let's say, you know, in a scenario where I did have some dollars that I got some losses, and I'm gonna try to offset them, right? And let's say I go ahead and do that, right? And I have an argument for it, right? I have a position, okay? So now I go ahead and I take that based on my position. People do that all the time, right? You know, I'm gonna take the position that I'm allowed to do this because I feel like I do have economic risk. There's probably a 98% chance that you're gonna get away with that, right? Probably shouldn't say that from the camera, but there's probably a 98% chance that you're gonna get away with that, right? It's not, there's a very low chance that you're gonna get looked at, right? Now, if I do get looked at, right? That's my argument, you know? And I'm probably, like, I'm preparing your return, right? Then we're putting that research right in your file. It's gonna be there in case, right? Proactive. Right, you know, so that's the whole thought. We would look at we would look at various people's positions. We would, you know, say, okay, look, this is, you know, something that we can hang our hat on. You know, there's times when I do a lot of tax insurance to find, something we can hang our hat on in the code. Because again, there's no black and white. So in that scenario, right? Because nobody said you can't do this per code section 153. -A, you know, section 1, right? It's interpretation, right? And I think we were talking about this before, where there's actually different accountants who disagree on the topic, right? You know,
Exactly right.
and so they could both be right in theory, right? Just based on the interpretation, because they could both be right because they're dealing with two different people.
Well, I guess if you have a good argument, the worst case scenario, you're not gonna get a penalty, you'll have to pay it back if they don't support your position.
That would be correct. And you probably gotta pay some interest, right? You know, but that would be the thought process. And look, I have clients who are so conservative, right, that they don't even want to take bonus depreciation, right? You know, I don't want. That sounds risky, you know, right? Okay, you know, whatever, right? Or I need dollars to qualify for my next deal. Don't take bonus depreciation because I have to get financing, right? And you're going to make my income zero, right? The bank's going to look at that. They're not going to give me a loan, right? So sometimes we literally back up because ability to finance and absolute tax reduction don't necessarily always go hand in hand, right? Now, so people, I'm not going to take certain deductions. And then I have some clients who are so aggressive that their attitude is, I'm taking everything, you know, and plus, right? You know, and you know, those are harder returns to sign, frankly, you know, I mean, you know, but you have to look at it and say, okay, does this, you know, so I'll give you an example. I have a guy who he literally owns, he lives in your neck of the woods too. He literally owns one condo in San Diego, right? And he heard that you can deduct an SUV, the cost of an SUV, against your rental properties or whatever, right? So he wants to go and buy a $90,000 Range Rover, and he wants to deduct it against his condo. And I'm like, no, right? You know, you're beyond, you know, the course of, you know, what is even reasonable, right? But you know, so that's what you deal with, you know, and some of these people have pretty larcenous imaginations.
Is there any way around the 150K? Like, let's say that you and your wife combined income is above the 150,000. If you guys file separately, or do you actually have to be divorced in order for it to still be 150K? As your
It actually, it's if you file separately, it's half each, so it becomes 75 each.
Okay.
But so at 150K, so let's say you were at, so there's nothing we can do with the person who's at 400K, right? Okay, but let's say you're at 160K, right? Okay, and you own a bunch, you're actively investing in properties, and you're going to be able to take some deduction. So I would look at your stuff. That's why we do tax planning. So maybe I'm looking at your stuff in October, and I'm saying, well, you might make $160,000 this year, but you haven't contributed anything to your 401k. Go make a 401k contribution, right? Because if you go and you make a 401k for, say, $10,000, and your wife goes and makes her 401k for $10,000, well, now you're at $140,000. Now you can deduct a little bit of that rental loss, right? But what you did was you got a double hit, right? Because you saved tax on $20,000 that you deferred, right? Plus you got to deduct whatever the loss that you were allowed to take on, so it would be $5,000 in extra, because it's prorated between 100 and 150. So that $25,000 is prorated. You lose the ability to deduct $500 for every $1,000 you're over 100. Okay, so the $25,000 rule faces out at 150, right? So at 140 you're allowed to deduct 5. So, but in that scenario, you actually cut your taxes. You have to cut your income by 25 grand, which means you probably cut your taxes by at least $5,000, right? And that took me, all of half an hour to look at, and somebody charged you, $250 to take a look. Maybe it took me 45 minutes to an hour to look at it, and I'm like, do these two things. It's not complicated.
That does carry forward though, if you don't, right?
Totally, like in any scenario, it carries forward, right? And not only do you never lose it, it carries forward and you're going to be able to use it, but I see a lot of people doing, so we've been doing, I've been personally involved in doing cross-segregation studies since the late 90s. It's not a new phenomenon. There's a lot of people out there who are like, ooh, cross-segregation, what you have to keep in mind is it's not a cure-all. It's not a no-brainer either. I've got people who call me and say, I want to do a cross-segregation study. Okay, well let's talk about this. How many years are you going to hold the property? 2. We're going to sell it in 2 years. No, bad idea. All right? You're not, I'm going to hold it for 10. Okay, better idea, right? Because now I'm going to, because at some point I'm going to recapture that depreciation. So if I take $100,000 of depreciation in year 1, okay, I'm recapturing $100,000 in depreciation in year 10 when I sell the property. That's not a bad trade-off, because I got 10 years use of the refund money, right? And when I go to pay it back, I've got 10 years of inflation on that dollar, so I'm paying back with less valuable dollars, time value of money, right? 2 years, I'm not getting that big enough hit, right? Now, there's another thought process there where I can look and say, so I'll give you an example. So I have a client who had a really great year, right? And he bought property. And so and he's a real estate professional. So he made like $1 million in commissions, right? And he's going to end up paying tax at 35%, and on his $1 million. So he says, well, I'm going to do a cost segregation study. We're going to offset. We're going to take $200,000 of depreciation against my $1 million worth of income, right? So he's saving money at 35%. So that $200,000 deduction is worth like 70 grand in taxes, right? Okay? Now, think about this. Even if he's going to sell the property 2 years later, right, the maximum recapture rate is 25%, right? So you recapture at ordinary income rates up to 25%. So in his case, that might not be the worst idea in the world. Why? Because even though I'm going to recapture the whole thing in 2 years, I'm gonna recapture it at 25%. It's not genius, I didn't save tens of thousands of dollars, but I do have a 10% spread between the 35 I saved in year 1 and the 25 I spent in year 3, right? So when I say to you, we have to look at the specifics of your situation and exactly what your intention is and what you think your rates are gonna be at a given time. That's exactly what happens.
So besides, for example, 1031 until you die, your heirs at a stepped-up basis, is there any other tricks to eliminate taxes? As far as real estate?
I love 1031 until you die. You know, honestly, I mean, I think that's the greatest. I think that's the greatest tax strategy there is. Right? You know, as long as you're not, you're not being, you're not shorting yourself on life expectancy. You know, but yeah, I don't think there's anything. I don't think there's anything wrong with that. I've seen people defer literally.
Besides that, to literally eliminate tax.
What about?
Never sell. I mean, I guess you're gonna die at some point, right? Yeah, but never, yeah, never. I mean, if you don't sell, you're never triggering recapture. You just hold the investment. And then, but again, that's only, I mean, it's the same strategy basically.
Or refi, right? Refi or not.
Well, I mean, we can't. Refinancing doesn't affect your cost basis except to add some loan costs to that, unless you're putting the money back in the property.
Well,
Right?
I guess refi is a deferral. It's not. You're not paying taxes on the money you pull out.
Oh, no, yeah, exactly. I am taking tax-free dollars out with a refi for sure, absolutely. But ultimately, that doesn't affect my basis, so when I do go to sell, it wasn't money, I refi and put money back on the property. That would add it. But ultimately, the only real strategy for never paying the capital gains ever is drop dead, yeah.
In which case, who cares?
Yeah, right.
Yeah, so one thing you haven't touched on yet is another way to actually have a couple actually qualify. Only one of the two have to be a real estate professional, as long as they're filed jointly.
Right,
So another
that's
way,
true.
like a lot of high income earners, physicians, attorneys, things like that, their spouse stays at home, they can actually now become a real estate professional, as long as it's a true, legit real estate professional. They're working the 750 hours, 15 hours a week, and 50% of their time.
Yeah, and when I tell you that I spend 5 hours a week consulting with people on how to make their lives legit real estate professionals, I mean, it's almost I'm gonna package it. It's like a cottage industry at this point. Everybody wants to do it, I'm gonna sell a course, how to make your wife a real estate professional.
Does she have to be a licensed real estate?
She doesn't have to. She could be managing all the properties. Like if you were a high income earner and you went out and you bought 20 single family houses in your town, right?
Yeah.
And you say, okay, you're the property manager now, right? So you don't have to necessarily have a real estate license. I like if you have a real estate license. I think that gives it validity, right? But I want you to be engaged in. Some legitimate real estate activity that you're actually generating money from, right? So I think it's very important that if you're gonna say, I'm gonna make my spouse a real estate professional, that your spouse actually makes some money as a real estate professional, right? Go ahead.
What if I put her picture up on my management company's website and she's the person you gotta go to?
Yeah, document it.
Yeah?
Yeah, well, and that's all well and good until you end up in the nice lady's office in New Haven, with where she's asking you for your lot. Go ahead.
So actually, we're a business partnership. His wife is a real estate agent. But the question is we made the partnership before they got married. Does she need to be on the partnership in order to be able to deduct
No, she doesn't, right? But here's she just has to be running a legitimate real estate related business.
She closes her own deals and everything else. I mean, she actually is earning money at that side of the profession.
Right, and if that's all she does, and that's more than 50% of what she's doing, and she has her 750 hours in, you're good to go. So when I'm trying to tell people, hey, this is how you got it, this is how you want to structure it, because everybody wants, well, she doesn't really want to actively work. Yeah, this documented, right, yeah, she doesn't really want to actually do anything. Well, that's not gonna work. I mean, it might work, you probably gotta, you probably got some, probably got some chance of getting away with it, but it's not legit, right, So I would rather you have a bulletproof, thought process, and if you're going to do that, then actually do it the right way and
Does networking count as a real estate activity?
no,
Oh, shit.
no.
So I thought of one, I'm answering my own question, opportunity zone. It's the only way to get rid of taxes.
Yeah, but even opportunity zone, right, okay, opportunity zone is a deferral till 2026.
Yeah, but I thought if you,
Oh, they actually just changed the rule, they actually just finalized the rules. Up until the other day when they finalized the rules.
tax free.
Only thing you have is volume of the property, not the thing you put into it.
Correct, right, yeah, but that's the big opportunity. Whatever you put in, you ride that appreciation for 10 years, you make all that money in 10 years, that's tax free.
Right, you get to step up in basis on that,
Yeah, so
on
that's
that
a-
property you
that's
bought.
great
But, so that is, right, okay, but, so think about it from this standpoint, right? So I get this question all the time, right? And so, there's a couple of, so, great opportunity to defer capital gains, right? But, okay, at one point, right, so Brooklyn's come a long way, right? A lot of people who lived here maybe 30 years ago, this is not the same Brooklyn, right? Okay, so, but there's a lot of places in the world where, I wouldn't be betting on massive gentrification to make dollars. So if I have $1 million and I want to defer $1 million gain, and I go into some neighborhood in, well, I live near Bridgeport, Connecticut. So if I go into Bridgeport, Connecticut, which is an okay city, but there's some rough parts. The opportunity zone areas are rough, right? And I buy one property and I fix it up, right? I have a nice building in a crappy area, okay? That's essentially all I've got, right? So now, and that nice building in 2017, the guy who owned it probably couldn't have given it away, right? He probably had it on the market, and people were saying, you need to pay me to take this crap all of building, right, And now, 2018, opportunity zone. Broker comes around and says, your building's in an opportunity zone. We could probably price that at $400,000 and sell, right? So you may be buying an opportunity zone and you're going to be deferring your gain, but the deferral is priced into the cost of the property, because the brokers have kind of seized on that and bought the market for those crapola properties. Not in every market, I'm being
Understand
general.
that you buy that property in an opportunity zone. Forget about, carrying forward a deferral. You buy it for 400 grand, you build whatever on it for $1 million, you got 1.6 in it, and all of a sudden, 10 years from now, that property sells for $5 million. The difference between the 1.6 and 5 is tax-free, because that was the gain within an opportunity zone.
Yeah, but
And I would tell you,
what Ted is saying is that 1.6, it's really only worth 800 grand, but you're paying.
I might tell you that but so think about it this way.
Some
You're
opportunities
assuming that you're gonna get, you're assuming you're gonna get 3 times appreciation in 10 years, right? I think you have a better chance of that building being worth 1.4 million in 10 years.
But you just asking a simple
Oh,
question.
yeah,
Is that gain taxable or not?
No, it's not.
Right.
You're gonna get this, you're gonna get the
So
step
case in
up.
point, when I sold my business, I had a building which is far from a depressed area in the middle of Durango, Colorado. It's an opportunity zone.
Okay.
And I sold it easily for $400,000 more than it was really worth if it wasn't. And so
Great.
that's what the provider is banking on, that they can then develop it and ride that free tax.
Right. And so, you know what, that's awesome, right? But you also saw what I'm talking about, which is you got the built-in bonus of it being in an opportunity zone.
Right.
So when I say, I don't love it I'm not saying I don't love it as a tax strategy, I don't love it as a real estate investor.
Sure.
You know, because one of the reasons people come to me, you know, for me to do their tax work is because not only am I a CPA with the rules, but I'm an active investor, okay? So I have a tendency to look at certain things and say, well, wait a second, that may make sense from a tax standpoint, but is that really a really good real estate investment, right? Because there's always going to be exceptions to the rules. And like I was telling somebody the other day, like if I had some inside knowledge of the fact that, say, you know, there's going to be a stadium built here, you know, in this opportunity zone. You know, some hedge fund is coming in with, $2 billion, and they're going to put blankety blank, you know, here, right? And if that's an opportunity zone, and I can pick up a property or properties nearby, awesome. Or if I know where the next Amazon distribution center is going, great, right? But if I'm just going into into any old opportunity zone and picking up properties just for the deferral, I've got a better chance of the property being worth less money 10 years from now than being worth more money than 10 years from now, because I probably paid a premium for that.
I don't want to sidetrack the discussion, but this just reminds me of something that I've been thinking of for a long time. If this opportunity zone thing really works out the way it's supposed to, is it the real play, just 1031 into a property, block outside the opportunity zone? If the opportunity zone really works and everybody's property values go up, yours is too, the block outside the opportunity zone, but you haven't taken that risk and you bought the property, it's cheap because you haven't got that inflation, artificial inflation from the opportunity zone, you see?
I mean,
But you gotta pay the tax unless you 1031
No, but
out.
you're 1031 again, so you're deferring those taxes, and then, then you can die later, but. And I don't want to sidetrack this. I had another question though. This is about the Tax Cuts and Jobs Act, and specifically about this LLC deduction. And I'm wondering, so that now they have this, if your business is an LLC, you get this automatic deduction off the top. How does that work, like with the interplay with these other deductions? Are they capped out, or can you take both? Like if you're a real estate professional and real estate's an LLC, your business is an LLC, and you're now getting this off the top, plus if you qualify as a real estate professional, can you get both of those actually? Can you get both of those deductions?
yeah, so I was using the example before of my client who made about $1 million in real estate commissions and then bought a building and took a $200,000 loss against that. Well, his net income for calculating the pass-through, right, was like $800,000. Now, he was way over. There's a cap. There's an income cap. Yeah, there's an income cap on there. But the income cap only applies on certain professions, right? So in his scenario, he actually got, and again, it caps out so you don't get the full 20%. But I think he got maybe $60,000 or $70,000 of it. He didn't get the full one because he got phased out. But he got something for it. He didn't get nothing.
So you can get both.
You can get both. You can get both. And that's, again, an opportunity for running numbers and planning and saying, well, wait a second. And actually what we did with this guy, which is kind of interesting, was, and this might be one of the reasons why he did get some money, was we actually took his dollars down by another $200,000 with a huge, because he was sole owner of his company, he was able to do an actuarial pension contribution for almost $200,000. So we took his numbers down that way too. But again, and that was, by the way, planning that we did in October, once we knew he was gonna have a good year. We also, at that point, elected S Corporation and took his LLC back 6 months. So we did, in October, we did like 3 different things that probably saved them $120,000, $130,000 total.
In my quest to get Alex down to 0. Can you talk a little bit about conservation easements and how that, do you have any thoughts on that as a tax strategy?
What is that?
Well, that's where I was.
Yeah, you know what? That's such an interesting topic because, to be honest with you, and I've been doing this for 30 years, I hadn't heard of a conservation easement until maybe about 8 months ago.
Really?
Right? I had never heard
You might
that.
take it.
I had never heard that term
Alex, you're gonna take
before.
one.
Right?
Yeah,
I've never heard that term.
It's not a huge windfall, I mean, it's, you know, if you've got a piece of, I've done it in a piece of property we developed where you're talking about a different.
It's the same, but no, the idea is, let me give you the results and then let me tell you how, what I've been told it works. Is essentially, you would make a $50,000 investment and you would get a $200,000 deduction. Because it's not really an investment because the 50 grand goes away, it's actually kind of a charitable contribution, but in exchange for that contribution, you get like it depends on the promoter too, because it's a syndication. And some are more aggressive, and so sometimes people claim 6x, sometimes 4x. I heard 3 or 4x is more conservative, but some people will go 6x, 7x, where if you put in 100 grand, you get a write-off 700 grand.
Yeah, no, I did it more from a property.
From a property, yeah.
State.
So it's really an investment vehicle, not really an investment, again, it's a tax write-off vehicle that it just seems so, one of those things that seems too good to be true. But it's being pushed a lot lately, and so.
Yeah, well, and so I did look into it,
Yeah.
right? And what I found was that the IRS just recently set up a task force
Sure.
to look into these ones, especially the ones where the valuations were in the 8 to 12 to 14 times, So the thought process is I put up this money and I'm going to take a charitable deduction for 4 or 5 times that, and I'm going to have huge itemized deductions, and then that's going to reduce my taxable income, right? So after I found out about this, I've heard now I'm talking to more people who've been doing them, and I said, okay, great. I hope you get away with it, right? Because the IRS just recently set up a task force to look into these, and they're going. And when you hear the words IRS just set up a task force, that should concern you, right? Because they don't do a lot. They don't do a lot, right? Okay, but when they set up a task force, they're generally pretty serious about what they're doing. And so the IRS, 8-10 years ago, decided they were going to go after people with foreign bank accounts, right? And so they said, okay, all of you people with foreign bank accounts. So they were very concerned with UBS, right? So they went to UBS and they said, we want your list of all the investors you have who have Swiss bank accounts. And UBS said, no, we're not giving you that list. Swiss privacy law prevents us from giving you this list. And the United States government said, awesome. We're going to revoke your banking charter to do business in the United States. They said, here's the list, right? And then, so what ended up happening was they have this list. So then they basically told everybody, we're going to set up a task force. And if you know that you're going to be on UBS's list that we now have, then you should voluntarily disclose this fact, and you should amend your tax returns and pay a penalty. And if you do all of this in the next 2 years, we won't send you to prison, right? And so that became a cottage industry, how to disclose your foreign bank accounts, and for a good 2 or 3 years, that was 10% of my practice, to disclose your foreign bank accounts or whatever. But yeah, I mean, that's one of those things where the IRS is going to look at those, and those promoters. It's not going to be unfortunately, it's going to be the people who got into those and saved a bunch of money if they happen to get looked at. If they happen to be on that list, they may have to pay some money back, right? But it's the promoters who are doing the 10 times thing, who are probably going to have a major problem.
Because I know the actual thing is a legitimate taxing, but I think the issue is people are using it in a way it wasn't intended to.
It's the valuation issue, which is the problem. It's not the tax law is fine. You want to donate property, go ahead and donate property,
Right.
get the tax deduction.
Right.
If you want to donate property that you're going to value at 10 times what it's actually worth, and then write it off.
Right.
I think Keith had a question. Yeah.
So I was wondering if you have any information on a deferred sales trust and how that works.
A deferred sales.
Delaware statutory trust?
I think they're similar or the same.
I've never heard the term deferred sales trust. if you're talking about a Delaware statutory trust,
They may be the exact same thing, I'm not.
They are not the same
100%
thing.
sure. Okay,
Two different things.
okay.
Okay.
Then,
so I don't have any information about a deferred sales trust.
okay.
Yeah, could you talk a minute about unrelated business income tax and in the context of the syndication, who does it apply to? Who doesn't it apply to? What are some ways around it?
So, unrelated business income tax for limited partner investors in syndication occurs when two things happen, essentially, right? It's not that big of an issue, I don't think. I have yet to see one of these, and I do a fair amount of this kind of work. I've yet to see one of these that's actually a problem. And the reason is because most of the time, in a 5-year syndication, you're probably never getting a K1 that actually has income on it, right? So there is no unrelated business income tax on something that has no income, right? What you see it more is when people buy a property themselves, possibly, right, where they buy it with their IRA, right? And if you buy a property with your IRA and debt, okay, then whatever the percentage of debt is, let's call it a 50-50 deal, 50% IRA, 50% debt. When you actually generate net income, 50% of that net income is subject to UBIT, okay? Tax. There really isn't a lot of ways around it, except the ways that we would normally reduce taxes anyway, right? So maybe when we know that you're gonna be in that scenario, right, we start to plan around it. Maybe we do, you're gonna have some income, let's do some repairs. Time to do some repairs. Time to do this, right? Whatever. The other way to avoid it is to use a 401k instead of an IRA. 401k is not subject to UBIT tax. Okay? So, but a lot of people don't really know that. So that's why when I say to my clients, look, I want you to call me before you buy a property, sell a property, renovate a property, because if you called me before you bought a property and you said, I'm gonna buy it in an IRA, right? I might have discouraged you with debt, which is not easy to do, by the way, because you gotta get a non-recourse loan in order to be able to do it, right? So I think there's more hype around this stuff than there is actual people having this problem. So I do know somebody who was flipping houses in their IRA and ended up with a pretty large UBIT problem, right? Because they were doing 80% hard money loans on it.
Well, in this case of a syndication where you have a passive investor who's investing with their IRAs and they're writing a $100,000 check, for example, out of their IRA, and the syndication obviously is acquiring debt, don't you have UDFI issues there? Or, because there's part of it, part of my return is leveraged, right?
You know, what return?
If I put in $100,000 of my IRA money from a syndication that's debt, and then I get,
It's income based.
what about my capital gains tax?
Maybe in year 5, yeah, okay.
Because I have.
You're assuming you're getting a capital gain at the end, right? Yeah.
Yeah, so if I put in $100,000 and then 5 years from now I get $200,000, I think the idea is, well, I'm in an IRA, I don't get taxed. But the answer is maybe you
But
do
with
get taxed.
debt, you would probably get taxed, right?
So then the question became the 401k, is that something you could do like right before you sell, kind of thing? And that's what I'm hearing some promoters, that was really my question. So if I had
Transferring the interest out of, no, in this scenario, what I would probably do is I would have had them do it up front, right? Again,
But I didn't know, I had no idea, I didn't know what a 401k was, so it's in my IRA now.
yeah,
It's year 4.5.
tough boo.
I can't transfer my IRA interest into a 401k, a solo?
Yeah, you probably could, right? And then when it sells or whatever, and let's assume you get, you can do it, yes. There's a 99% chance you're probably 99% chance you're getting away with it, right? Because
But if I get audited,
we're
it's
talking
just
about,
aggressive.
but if I get audited,
yeah.
and I transferred it to a 401k a month before
Yep.
I did
Sure
that,
does.
that's an issue,
Okay.
for sure, absolutely. Yeah, I probably have a problem. Go ahead.
One question I get from my LP investors quite a bit is if they sell an LP investment, obviously they're not selling, but an LP investment is sold,
Mhm.
and there's a capital gain and a recapture from the depreciation that they took on that, can a future or another LP investment that year, that depreciative loss on that K1 offset that gain?
You know what, I'm thinking out the answer, right? Because that's a strategy that we use with a lot of people all the time, right? It's typically a real estate, but because that's a no-brainer strategy for a real estate professional, right? Because in that scenario, they're gonna, like, we do that all the time. We say, okay, you're then you do 1031, because 1031 is hard to do these days, right? So we'll just go and buy another property and we'll use the depreciation to offset the capital gain. So that's a very viable strategy. Does it work with a passive investor who can't deduct the
It doesn't offset ordinary income, but the
it
passive.
does, you're absolutely right. So yes, to the extent that you have a passive loss that flows to a new partnership, it will apply against the income from the old
So
partnership.
passive income can offset a passive loss.
That's exactly correct, that's exactly correct. Yeah.
So when it comes to retirement accounts, when you say it's better to use IRA versus a solo?
No, I would use, if I was gonna use debt, I would use a 401k.
Solo 401k.
Yeah, before I use my IRA.
So do you have any clients who have high W-2 income, who aren't really, like, they work at Apple, where with proactive documentation, they have proven out that they work 40 hours a week or 41 hours a week in addition to their day job as a real estate professional? But what kind of documentation does that look like?
Yeah, do I have clients like that? Yeah, that's what we were talking about before, where, it's sort of become, how do I do this, right? And that's my job, right? My job is to teach you how you can do that. But at the same time, what I'm gonna tell you is, so if you're gonna document it, totally do it the way, we were talking about this before, do it the way you feel the most comfortable. Make sure that you're being very detailed with the documentation. The more detailed you are, the better off you are. Knowing that, high income W-2, if you're trying to qualify yourself, right? I'm not trying to qualify my spouse. I'm gonna try to qualify myself. I have a W-2 job. I'm telling you right now, that is a red flag. The IRS is looking at high income earner W-2 people who are claiming real estate professional, because their argument is, how the hell are you doing that? What, do you don't sleep? And that's, so your documentation better be awesome.
One more, time for one more question. Oh, okay.
Yeah, I just had a question. This is tagging off on what Alex was talking about, offsetting taxes. But if the opportunity came to you to massively over-leverage a property, which in a lifetime of 1031, you might have the opportunity to over-leverage a property that you have, take out a lot of debt, and then sell it almost for what the mortgage is on it, you would end up coming to the table with a little bit of money. I mean, I've sort of seen this done with residential properties where maybe they know it's worth 80, but the opportunity happens to take out 100, and then they sell it for 85 and come to the table with 10 grand. I mean, there's nothing to tax, but you've still got the money in the form of debt. What are they gonna do? And I mean, potentially, like, you could do that with $1 million or a $10 million property. If you 1031 4 times in a row, and it's your 5th one, you say, what, the market's really hot, I'm gonna take out more debt, negotiate out the loan covenants, turn around, sell it. Right? I mean, sort of convoluted, but I've seen it done, kinda, I think.
I think you're missing the original basis in the property, though. It doesn't matter if you took out debt and then sold it and had to come to the table with money, correct? It has to do with your basis in the property.
I'm still trying to figure out where he's getting somebody to, give them $150,000 on an $80,000 property. Okay, you gotta give me that company's name, man, I'm gonna be all over that. You're right, it's a basis issue, right? So, no matter how much money I pull out, so if I buy a $100,000 property, right? And the next day, some insane person wants to loan me $150,000, right? I'll take it, okay, right? So I bought it for cash, now somebody wants to give me $150,000, right? I'll take it, right? Because I still owe them $150,000, right? Okay, in theory. Now, I turn around and I sell the property for $150,000, okay? I give them back their $150,000, okay? Right? I paid them off. I still have a $50,000 gain on the property because I only paid $100,000 for the property to start with. Make sense? Maybe I got to use, so let's lag time it and say I got to use the $150 for 10 years before I take it back. Same thing.
This is the issue why some people are so desperate to do 1031s, even ones that don't make sense. Because if they pulled so much money out of the property over time, they can wind up with, when they sell, having basically zero cash in their pocket after they pay off their loans with a huge gain on the property.
Yeah, but they took all the money out.
Right, no, but I'm saying they may have spent that money, they have nothing to pay their taxes with, so they have to do a 1031. It's like, they might have had the money, right? But they might have money to use it, right? So you just, in theory, they're so highly leveraged, they don't have any cash. There's no cash coming into the deal to pay the government.
Right, so then you're gonna end up doing, so you have to do a 1031, right? And so that's fine, right? Do the 1031, but so there's nothing wrong with that from a tax standpoint. From an investor standpoint, you just put yourself in a bind because now I gotta go for what, especially in this market, in a market where there's all kinds of properties around for sale and you can pick up great properties. That might be a great strategy. But right now, just doing a legit, straight 1031, trying to find a replacement property on anything is tough. And when you're doing, when you're looking at a 45 days to identify, 180 days to close, right? You're probably picking up something less than ideal, right? Last question.
I got an oddball question. So, other than dying, is this a way to avoid taxation at 1031? Because I don't think insurance payouts would be taxable, right? So say you 1031 to a whole bunch of them, and then you're in a property and it burns to the ground, you're not going to rebuild it.
It burns up by itself?
You get insurance.
Yeah,
I'll let it was smoking and it burned down, and it's out. So then you get paid out of insurance, you demo it, you level it, you sell the lot off, and then the only gain you have is on the lot. So is that a way to get rid of it?
Yeah, but in that scenario, right? In that scenario, you in essence sold the property for the insurance proceeds.
Yeah, but insurance proceeds are not taxable, right?
In that scenario,
They are? Oh,
Sorry,
it didn't happen.
yeah, in that scenario,
They're not taxable.
So listen, Ted has actually gone over some, so thank you.
Oh, so sorry.
No, you're the last speaker, but I'm just saying you must be tired. But anyway, I want to thank Ted, and I want to thank all of our speakers today, and everybody for coming out. This has been really great, so I appreciate everybody being here.